Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark tells us equity markets are in a seasonal pause. Real estate consultant Ross Kay believes Vancouver's housing market is crashing. Wall Street window editor Mike Swanson contends the equity markets are headed for a drop. Mackey Research's Payton Nyquvest wraps up Canada's junior markets. We'll talk to Ross Clark right after this.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always good to be with you, Jim.
An interesting week on the stock markets. People keep expecting them to crack. We see little breaks, but then they bounce back.
Oh, yeah. We've got so many analysts and advisors out there looking for this September-October crash in the market. We've gone to a non-event summer after the Brexit, and Q4 promises to have lots of policy changes from central banks, political changes, both in the U.S. and then as we move into Europe next year. So everybody's pretty concerned, but the bottom line is that the volatility that we failed to have in the summer, we are clearly having for this last 6 days of trading. I think Friday was one of the few days where we didn't have a 1% day. But market's holding up for now. From our seasonal perspective, this is where you expect to see the market slide off. I think you've got better than half of the September-Octobers historically do manage to see the market slide. And when we're in an election year such as this one with a second-term president, you start off the early part of September generally a little bit weaker, see some more weakness as you get into the end of September, October, and that 7% level, 7% off the high, is pretty much what we would be hoping for. Right now we're down a good 4%, flirting with some of the long-term moving averages like the 50-week and the 200-day. So probably holds around here for a short while, but has further pressure to be had. So this is the time when you sit back and you look for the value stocks that you want to be picking up during the breaks, because historically we know that you want to be a buyer out there in that October, early November window for a good run into the end of the year.
What's happening with the U.S. dollar and how's that affecting gold?
U.S. dollar had, it's still stuck in a trading range, a broad range, but it did close near its best levels that we've seen in over a month. And with that, you've got the gold market down, I believe, here, testing the lows that we saw in the summer, just flirting around the 1308, 1310 range. And the outlook there continues from our perspective to be for a deeper correction, especially in the mining stocks, the gold miners, the silver miners. Optimum move once you've started that first leg of a bull market, which we're assuming happened the first 29 weeks of this year. We would be expecting this correction to last at least 7 weeks. That'll take us to the end of September, and hopefully by the time we push into the fourth quarter, we've put a bottom in place.
The price of gold bullion, is that expected to keep falling too?
Well, some of this is going to depend upon next week's action with the Bank of Japan in terms of what they're doing with interest rates and also with the Fed. Any time that you're looking at gold these days, you have to be looking also at the interest rate side of the market, because as other administered rates start to move up, it makes gold less attractive than it has been for the last year or so. So we'll be watching pretty closely to see what happens there. The bond market did take a good hard hit at the end of last month and the first part of September. stabilize this week. And, in general, we're expecting to see bond market slide off over time, not in a dramatic way, but just start to see some higher yields. The 10-year U.S. yield's around 175 right now. It should end up pushing through 2 as we go into next year.
The European banking crisis, will that upset economics in North America?
Well, I guess to a minor degree, I prefer to look more towards where are the opportunities, and in this case, you want to be, if you can, you want to be short the European side of the market. If you take a look at the stocks index over there versus the S&P, it's a nice spread trade, being on the short side of Europe relative to North America. I don't know that we want to take, you don't need to take an outright trade, but the spread relationship should have some pretty good returns there.
Ross, if somebody wanted to get more information from you, how could they do it?
They can get me on the internet at ross.clark@cibc.ca or in Vancouver at 604-661-7759.
Ross, thanks for being on This Week in Money.
You're welcome.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Coming up, real estate consultant Ross Kay, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
We're chatting with real estate consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to This Week in Money, Ross.
Thanks, Jim.
A reminder, this interview was recorded on Thursday. Some of the numbers that you hear in this report may have changed by the time you hear it. The big story across Canada, of course, has been the monstrous increase in real estate prices in Vancouver and Toronto. But what's the real state of Vancouver now, and can we believe the numbers recently released by the Canadian Real Estate Association?
Okay, so the average consumer should never rely on numbers released by the Canadian Real Estate Association or a local real estate board. Those numbers are really of no value other than to assist you in deciding to, yes, I need to buy that house and I need to buy it today. All of their numbers are designed right from day one, back in the 1980s, and modified consistently month after month to make you make that choice. It should only be logical that an association who is representing its members, who has a legal obligation only to represent its members, and no legal obligation at all to benefit the public, would only release data to the public that drives more and more sales, or drives them as easily as possible. So what the Canadian Real Estate Association released today should be being scrutinized in every newspaper across Canada, but unfortunately, as we said in your show before, Canadian press has been financially throttled by the papers and their editors, and any real investigative reporting about real estate data has been non-existent basically for 21 years now. So what was released today from the Canadian Real Estate Association, I can assure anyone here, is virtually 100% nonsense. It may sound logical. It may make common sense. When you look at your own market, what they're saying may make sense to you, but it only makes sense because you've heard that same message probably since you first started learning or listening about housing. And it's probably the same message your parents before you heard and repeated to you as if it was gospel. Unfortunately, it's not.
The Canadian Real Estate Association released its latest numbers. Are they accurate, and what are the real numbers?
Okay. No, their numbers are not accurate. Now, what I mean by that is that this specific month, August, your listeners would have heard me say in the past, talk about bump month. And everybody across Canada said I was a nut. Bump month, what is this guy talking about? Nobody would do what he's claiming that the real estate boards do. Well, lo and behold, 30 years after the first bump month happened, this month, the Toronto Real Estate Board admitted bump months are a reality. When you have someone like me who knows as much as I know about the MLS infrastructure, and that's not an arrogant comment, that is something that I have deserved after decades of research and years of simply studying the system so I know how it works. They know that they're caught. So over the last 3 years, gradually, every time they see that I brought something to the public's attention, within 2 months, they go back and try to, well, wait a second. Here's what the real story is. Bump months just got explained by Trev this month. For the first time, they admitted there were 2 extra working days in the month of August in 2016 over 2015, which artificially inflated August sales numbers in Toronto by 13%. So they admitted that. It's included in their press release. It's included in their monthly data. It's included in their statistics. That comment now is on the record and recorded by them themselves. Okay, Ross's theory on bump months has just been proved. Today, Korea releases, they don't tell anybody that there were extra reporting days in the month of August across Canada. So, people, when we're comparing against August of last year, make sure that you adjust your numbers. Even if you adjusted them, the simple 13% that the Toronto Real Estate Board suggested you needed to correct theirs by. Now, what I'll tell you is they're really wrong on that too, but I'm not going to explain to you how much more in error the working days and a bump month actually is, because that is part of our proprietary ability of timing the market. What I will tell you is they have underestimated the inflation factor of August this year. But what happened today was Korea didn't tell anybody that that's what happened in this August. So they claimed that their sales were up 10% on an actual basis, when in fact, if you remove the even just the 13% error that Trev admitted to, your sales for August of this year would have been below last year's. So you know you have real estate boards now, different associations, fighting against one another, trying to say what we've said in the past is not wrong, this is how we're getting around it. Oh, don't look at our old press releases. Don't compare us to what the other guy says. This is what's really going on. And again, generally, they're all wrong. So Korea's release today was inflationary across every market in Canada in terms of this number of units sold. The result of the way a housing market functions is, because at the end of the month of August, you generally have slightly higher selling prices than you do in the first 3 quarters of a month. So at the end of the month, the people who had sold their cheaper homes are now buying more expensive homes, and those selling prices are higher. So if you carry forward 13 to 23% of those sales that happen to be higher price sales from July into August, then that artificially inflated August sale price. What that means is the little tiny $2,000 gain that was actually recorded nationally may have in fact now indicated that in the second half of August, the average selling price may have fallen. You won't know that now for another 60 to 90 days because of the way real estate data is reported. Of course, we know exactly what the number is, and I can give you the number for 3 months ago to show you just how wrong the Canadian Real Estate Association normally is.
How is the Vancouver market doing so far this month?
Odds are we're going to change our correction call to a full-blown crash. So as you know, in July, we said we had forecast back in May that in August the numbers would go negative. That meant in July we expected to call a contraction. We called the contraction in July. Negative numbers hit in August, which we had forecast back in May. So that meant that we could actually say your market has now entered a correction. And what we know already by the data that's coming in, it looks like Vancouver is in a full-blown crash mode right now. It looks like the Vancouver market is crashing. What is a crash versus a correction versus a contraction? So initially a market contracts, which means sales start to decline. Prices may stay high, but sales start to decline. This is one of the first warning signs, because without sales in 1 month, you're not going to have sales in the next. This is why this supply and demand constantly being brought up by the real estate boards really makes no sense. It would make sense when we're talking about a 5 or 7 year period of time in terms of the housing stock having to grow, because we've got a whole bunch of new immigrants coming in, becoming new Canadians, and because new demographic, bunch of people getting married and forming new households. That's a supply and demand issue, but supply and demand in a real estate market really is a long-term thing, and nobody can adjust rapidly to make supply and demand enough supply impact the demand. I know what the demand for new housing stock is going to be 5 to 7 years out from now already, so I could tell you how many houses need to be built. That being said, in Vancouver, you have had declining sales, contraction. Your market peaked in February, as I've told you here, and again, all of the real estate board guys, they all laughed and said, this guy doesn't know what he's talking about. Meanwhile, 5,000 families have used my services to sell houses over the past 30 years. I don't know what I'm talking about. Well, your market peaked in February. That's when peak price happened. Your prices have been falling since that time, and sales have been slowing. You entered a contraction in July, meaning year-over-year sales were negative, the number of sales. At the contraction time, housing prices are still high. In August, you entered a correction. And what that means is there's no longer any speed in the market left. The speed now is going towards the negative. It's driving the market deeper. When that velocity reaches a point that the market can't turn itself back up, that's what's called a correction. Normally that takes 2 or 3 months. Vancouver's it happened in August. The reason it happened is the money laundering Ponzi scheme, as was reported here in your station, BNN, and in newspapers across Canada, collapsed. And when a Ponzi scheme collapses, the last people in no longer can get their money out, and the market dies. That's exactly what happened to Vancouver in July, and that showed up in August. The government brought in their 15% tax. What that means is right now, foreign buyers will not re-enter the market. The Ponzi scheme is over. If a new Ponzi scheme has to start, so be it. But the old one, the old methodology of multiple flips and single homes, simply to get money out of China, that's over. That's resulted in enough velocity in the downward trend that Vancouver has now entered. Again, I'd like to wait till Monday, but pretty much you guys are in full crash mode, and it is not reversible.
Vancouver City Hall is going to impose a vacant property tax. There's some 10,000 homes that are vacant right now. The whole idea, I guess, is to increase the rental units available in the city. Is this a good idea?
A vacancy tax on foreign-owned homes is a sensational idea. A vacancy tax in an environment like Vancouver is a fantastic idea. What the government needs to be sure to do is that their top threshold, which they've established at 2% of the current market value per year, should be the minimum vacancy tax that they install. My preference is 3.7% because that puts the onus on the owner not just to break even, but they also have to actually need some appreciation in value if they were to hold on to the house as a vacant property. And now that you've entered a crash, it looks like housing values are going to be dropping. So the 2% over the short term is probably adequate. The reason it's adequate is this. 2% on $1 million property will be judged as of July of this year. The way that your property assessment corporation works is you're basically going to use peak price of 2016 to establish your property taxes for next year. Now, for the regular homeowner, that will mean there will be no rise in property taxes because everybody's taxes are set at peak price. So that really is not going to be a factor. Now, again, as I've said into your show before, the property tax methodology is already flawed, and about 95% of people pay too much tax and 5% don't pay enough. That being said, a 2% tax on peak pricing, where housing prices by our calculations are already off more than 20%, which you're not even going to hear about until next February. What that means is that the 2% tax is effectively almost a 2.5% tax. So for the next few years, or as long as housing prices are falling in Vancouver, even a minimal 2% tax is actually higher than what it's really going to be, because it's always going to be on the previous year's gain.
What is Canada Revenue Agency's Form T2062, and how does it affect Vancouver's housing bubble?
T2062 is a form that has to be completed by a owner of a property where it's going to be subject to capital gains. Apparently, realtors in British Columbia have failed to inform home buyers that those forms are required by a seller, such as a foreign owner, who is subsequently going to have to pay capital gains tax. It is the obligation of the Canadian resident home buyer to hold back, let's use the term hold back, to hold back 25% of the purchase price in an escrow account to cover the obligation of the foreign owner who is going to have to pay capital gains. The only way that form, you're always going to use the form, but the realtors should have always been asking for a copy of that form and for a certificate of confirmation, which is another government document that simply states, Joe Schmo from Hong Kong is going to have to pay $100,000 capital gains on this property if he sells it at this price. Make sure that the buyer's lawyer holds back that $100,000 so it can be remitted to the government. So if the home buyer, the Canadian resident home buyer, purchased a home from someone who has to pay capital gains on that property, i.e., it's a flip, i.e., it was a rental property that is now taxed as a capital gain. It is a foreign buyer who held the property who has to pay capital gains tax. It is the responsibility of that Canadian citizen to pay that tax, to hold that tax back so that it can be remitted. If they don't do it, the fine is 10 to 20% on top of the capital gains they were supposed to withhold, plus interest and penalties. Apparently, realtors in British Columbia who were participating in these flips or even selling properties which may have been potentially due to pay capital gains to the CRA were not having those forms, at least a clause included in the offer warning the lawyers that this form needs to be completed.
How can a local buyer find out if the seller is a foreign seller?
There's several ways to do that. The best way is to knock on the neighbors' doors. The neighbors are going to know what's going on. Second way is to go to the land transfer office, get an ownership, do a Google search on what's going on. And then the third one would be hand it over to your lawyer and let your lawyer do it for you. If someone was asking me, I'd be calling my lawyer and he would be doing it. And that way I don't have to worry about anything.
To help protect banks from foreclosures, will mortgage amortizations be extended again?
One of the biggest myths made headlines across Canada yesterday was that if interest rates go up a quarter of a point, 700,000 Canadians are not going to be able to meet their debts. And what I'm going to tell you that's BS. What's going to happen is, at the current interest rate of 2.8% or even 3%, during the first 5 years of a normal mortgage, people are going to pay off 32% of their mortgage principal. What that means is, even if a property is owned by a first-time buyer, and this is really, Jim, this is why all of this talk about CMHC and the government being at risk in a correction is absolute nonsense. Everybody takes out a 25-year mortgage in Canada. They all make the minimum payments because they buy as much house as they possibly can. But even at that, they're going to pay off 32% of their mortgage in principal payments in the first 5 years. So what we have here is that by the time the 5-year amortization, the 5-year term in their mortgage comes up, interest rates can go up a full 1.5%. All the homeowner does is they go into the bank and they say, "Oh, we can't afford that higher payment." The bank smiles and says, "No problem. We'll extend your current amortization is now 20. You paid it off for 5 years. We'll extend it back to 25 years, which will make your mortgage payment exactly the same as it was 5 years ago, even though you're paying 1.5% more interest."
Is the Trudeau government likely to try and fix the real estate bubble, and could they be successful?
It's too late. The real estate bubble has burst. As I've told you, it's Vancouver. To me, has entered a crash. Will they do anything? I'm going to tell you no. They'll do nothing, because they're going to watch the BC Liberals get blamed for a net wealth deflation in British Columbia that is unheard of. I mean, the net wealth of British Columbians is set to plummet, and it's going to plummet so rapidly it will be of historic proportions, certainly in Canada, possibly beating even out the United States correction, because Canadians have a higher net wealth tied up in their home than Americans did. So I do not believe that the Trudeau government will move one iota to change the housing market.
Is Toronto's real estate market still bullish due to foreign buyers from China, or is that just a perception?
It is a myth perpetuated by realtors in Calgary, Edmonton, Hamilton, Toronto, and Montreal. That's made headlines in all of those cities. It is a myth. The foreign buyer goes to the place where they know they can manipulate the market, or where housing prices have a trajectory that their equity is protected. They are generally speaking, they want to hold the property for a long period of time. Generally speaking. Now that is the foreign buyer who actually closes on the property, not the one who's involved in the flips to get cash out of China or any other country. So that's all a myth. What everybody has to understand is, and it's just hilarious, the Toronto real estate market is huge, as Donald Trump would say, as compared to Vancouver. Toronto is only selling about 12,000 single detached homes across the entire GTA a year. Only 12,000. Vancouver was turning 18,000 just in the area represented by the Real Estate Board of Greater Vancouver. It was impossible for 18,000 detached homes in Vancouver at over $1.7 million average to be selling. It was impossible. there were not enough sales of lower priced homes that could make 18,000 sales take place. Vancouver's market actually was, as you entered this portion of the trading cycle till when you just exited it, which you exited it in July, the number of single family homes, the pace of sales they were on had doubled, a 100% increase. Toronto's is only up 15%.
Ross, thank you so much for chatting with us.
Hey, thanks a lot, Jim. I appreciate the call.
My guest has been real estate consultant Ross Kay from thewealthyhomeowner.ca. Coming up, Mike Swanson from Wall Street Window next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Mike Swanson, editor of WallStreetWindow.com. Welcome to This Week in Money, Mike.
Oh, it's great to talk to you. It's been a very fascinating September after an August that pretty much made everyone fall asleep.
And of course, when people start paying attention to the markets, there's always the possibility the changes to the market will be something you don't like.
Yeah, or something that's going to surprise you. You know, when we spoke in August, the U.S. stock market volume totally vanished. And the volatility vanished to levels I've never seen in my years of trading, and I've been doing this since the late 90s. And what in particular happened was the day-to-day moves of the U.S. stock market shrank. The Dow, for instance, didn't go up or down more than 100 points on a close or closing basis in any of the days in August. And this followed that Brexit drop that was a 2-day drop in June, and then we broke out to new highs, and the S&P 500 went up for about a week and basically stalled out and drifted and went nowhere. And there's different ways rallies and bull markets can come to an end. They can have these parabolic blast-offs, and that's kind of what we saw with the internet stocks in 1999 and 2000. Silver prices did that at their last bull market peak. However, sometimes you get bull markets that just kind of drift around, and the volume and volatility can shrink, and then you get a dump that starts. And I think that's what's happening. But the most important thing, a lot of people don't agree with that and think, you know, this is just a little pullback we've seen in the past 2 weeks. But the bottom line thing that's the most important for people to realize, they can understand what's actually happening in the stock market, because what we've been seeing in the past 2 weeks are giant swings up and down. The Dow fell over 300 points the other week, and then Monday it almost took all those losses back. And then it went straight back down and gave them back up, and then it went back up, and so forth. And so all of a sudden it's making these wild moves, and people are getting confused by that and why it's happening. But that's what I really want to explain, is the key thing is we had a month of August in which the volatility went to nothing. One thing I use to measure that are the 20-day Bollinger Bands. And they got to a point that hadn't been seen in decades. And now, when that happens, when the Bollinger Bands narrow and volatility narrows and goes to nothing, that's a situation that leads to a wild expansion in volatility. So that's what's happening now, and why the stock market is making all these wild swings all of a sudden from day to day. Is we're now in an opposite environment that we were in August. We're now in a very volatile environment, characterized by big swings up and down and temporary moves that don't go anywhere, and it seems very confusing. But the bottom line is lots of fake moves, lots of wild swings day by day, and that's what's going on. A lot of the moves, frankly, aren't going to mean anything, and a lot of the moves we've seen haven't meant anything when they happen on a daily basis. So they have to be understood in a bigger picture.
And what is that bigger picture?
Well, I think it's that we're now entering a stock market downtrend from February to the first couple of days of August. We were in a big uptrend. Now we're in a downtrend, and I can tell you what people should look out to see if I'm wrong or correct on this, and then what's going to happen. Because one thing you don't want to do is just listen to someone say something and take it like, well, that's a prediction, and I'm going to bet on this prediction and just, believe in something. That's not what I want people to do. I want people to understand what's happening, and then they can see, how it develops. Now, the thing about a rally in the stock market is when you have a big rally, you can get pullbacks that are sharp for 2 or 3 days at some points in time. But you don't get drops of 20%, in a big rally. That's how, drops in. So if you think about the gold stocks, too, up until August, we only had pullbacks that only would last a few days. And then you just go right back up. And the U.S. stock market, the same thing. The Brexit event was only a 2-day drop, and then it bottomed and went straight back up. So if you think about the stock market, not this Friday, but the Friday before, when the Dow fell over 300 points, on Monday it came back, then it went back down, and so forth. If we're really still in a big uptrend, you won't keep seeing that happen. Instead, you'll see the market rally up to a new high very soon, this week or the next week. That should happen. However, if instead we simply break the lows recently made at the S&P 500, for example, were to end this coming week below 2050, that would be a sign that we really are in a downtrend. And if that's the case, expect this simply to continue. Fake one-day moves, tricky rallies, but all in the context of lower prices from week to week until finally this downtrend comes to an end. So, in other words, the type of volatility that we have seen, if you're really in an uptrend, it only can go on like that for, about a week. If you're in a downtrend, it can go on for weeks on end. And that's basically the type of action that characterizes markets that trend down. You get a move over time that's lower, but those moves are interrupted by one-day rallies that keep everyone in and believing that nothing's wrong. In reality, most people in the United States are fully invested in the stock market, if they're in the stock market, without cash reserves. And I think what people really need to do is raise cash reserves if they don't have any, so they can buy in at cheaper levels. And also be cognizant of the fact that at some point, this gold and gold stocks have been in a little bit of a correction, and that's going to end, and they're going to take off too. Especially the stock market declines, they'll eventually go up as a result of that, because there'll be rumors that the Fed will, have to do something, print more money, or do this and that. We're not at that point yet. We still have people on CNBC talking like they're going to raise rates in December, but let the S&P 500 go below 2,000, and that whole notion will flip, and they'll be looking for more money printing or begging and demanding it at least.
Well, also, too, they say the Fed will make its decision on interest rates based on economic facts. Well, August manufacturing and production was down, so were retail sales in the U.S.
Yeah, that's right. And that's kind of put the hammer to the idea that they're going to raise rates when they meet at the next meeting, which is Wednesday. Put the hammer, I mean, get rid of it. I mean, I don't know anyone who believes that anymore, even though that was talked about 6 weeks ago. The economic data just kind of makes it so it's not going to happen. And if the economic data doesn't pick up, the odds for the December rate hike will vanish too. But in the end, I think at this point in time, in the United States at least, the stock market is driving the economy, or at least keeping it from tipping completely into recession. The economy is not really growing in a meaningful way, but the stock market going up has created the appearance of that things are okay. As long as the stock market's gone up or not fallen, people in the United States have decided to believe that the economy is good, but if it falters, all those beliefs will vanish overnight.
What about all the foreign investors in the U.S. stock market? The Swiss government or central banks heavily into it. Japan's heavily into it. Is that a dangerous move on their part?
Well, the thing about that is there's all sorts of stories saying that there's foreign money flowing to the U.S. stock market. And in reality, most of the buying that the Japanese central bank has done of stocks has been buying their own exchange-traded funds, and the Swiss bank has done very little. And there's no evidence that the European bank has done any at all. So I think a lot of those rumors are kind of exaggerated. In reality, the money flow data that I also last saw a couple months ago was showing that the bulk of the buying over the past couple of years has actually come from corporate share buybacks, where the small individual investor has actually, barely put more money in the market than they've taken out, and their role is diminished. And even the foreign investors as a whole, across the entire world, have taken more out than they put in over the past year and a half. And it's the corporate share buybacks that has bridged the gap. The problem with that is around New Year's, there are all these predictions for the stock market to go up based on the notion that corporate share buybacks would increase even more. And what these share buybacks are dependent on is the companies borrowing money, issuing junk bonds, then using that money to buy shares. And in August, there's a story on Bloomberg that said the buybacks have basically hit a brick wall, and the companies are paring them back. I think that's a fundamental reason for the stock market to go down. Without the share buybacks at the rate that they were, I think the stock market is in big trouble. And the reason why the buybacks are diminished is the revenue growth for the companies, for most of corporate America, is stagnant or negative. And they've reached a point where they can only go so far in debt, and now they've just hit that ledge and they've pulled back from it. So here we are, and we're going to see what's going to happen over the next couple of weeks. I think the stock market's going to decline, but, someone listening may find that hard to believe. So I'll just say, if I'm wrong, the stock market will go up, back up to the highs pretty quickly, that we saw earlier, like it did after Brexit. But if it goes down again, that'll be something it hasn't done, since February, make a low, and then bounce and go through it. It hasn't done that since February. And that'll be a sign, from a simple chart or technical analysis basis, that the trend really is down. So that's what people, I think, need to sit back, and if they don't want to sell because they think it's going to go up, well, at least figure out what would make you change your mind.
Mike, before we go, could you tell us a little bit about wallstreetwindow.com?
Oh, sure. It's a simple website, wallstreetwindow.com, and on it I put free articles, a couple of week blog posts about what I think is going on in the market and also the gold markets, because I think they're worth investing in. And if they join the free email list, they can get more information too.
Mike, thank you so much for chatting with us.
Thank you. It's great to talk with you.
My guest has been Mike Swanson, editor of wallstreetwindow.com. Coming up, Payton Nyquvest on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Payton Nyquvest, investment advisor at MackeyResearch.com. Payton, what happened on the Canadian junior markets this past week?
The TSX had a high of 14,626. The low was 14,319. Closed at 14,450, so down about 20 points for the week. The Venture had a high of 814.61. Low was around 796.24 and closed at 799.24 as well, so down about just under 10 points for the week. And the Canadian Stock Exchange had a high of 693.22, low was 668.23, closing at 697.84, so it's up 5.6 points for the week.
Compared to the European or U.S. markets, have Canadian markets performed relatively well this year?
Well, the venture market actually has been the top performing index of the year this year, so they've definitely been the leader.
Is that because of heavy interest in gold miners?
It's for sure the mining space has been what's picked it up. The gold miners, as well as some of the lithium stuff, and even some of the uranium deals as well.
Now, uranium prices have stalled out, but Japan plans to put more nuclear reactors into action. The UK is going to build a new one. Is that going to increase the price of uranium?
You know, that's what everybody's kind of been waiting for, and I think it will. So you haven't quite seen that trickle over yet, but I'm sure once the news starts coming out of those starting to get turned online, that it's going to have to drive the price.
The Canadian energy market still dead, or are people starting to look ahead and hope that this glut of crude is going to dry up?
You know, it's quiet for sure. It's starting to pick up a little bit. There's people that are now starting to look at opportunities as to where they can start sticking their toe back in, and I think that'll probably continue here through the fall.
Canadian diamond mining, anything hot there?
Yeah, things are getting very interesting there. Mountain Province is set to do their official opening of their mine on Tuesday next week, and is expected to be one of the largest mines that's definitely come on in the last long time. So there's a lot of excitement around that, as well as Stornoway, which is set to come into production here and is set to pay a big dividend as well.
And of course, De Beers likes to keep their hand in the diamond market. Are they sniffing around?
Well, they've got a 50-50 JV with Mountain Province on that Gaucho mine in the Northwest Territories, but they're also starting to do some additional exploration stuff. Working with a company called Canalaska, and they've got a program that they're drilling in northern Saskatchewan, and starting to do some more exploration stuff now as well.
Who would have thought that you would find diamonds in Saskatchewan?
Yeah, it's been, De Beers has spent a lot of money in Saskatchewan looking for diamonds. They're still trying to find something that's economic, but clearly they think that there's something there.
What about new diamond projects in the Yukon?
Not so much stuff in the Yukon. The Yukon has been very hot lately in terms of gold miners. There's been a lot of new gold deals that have come out of the Yukon in the last little bit, but not much on the diamond side.
Can you tell us a little bit about Mackey Research?
Yeah, Mackey's one of the largest independent brokerage firms in Canada. We got involved from Jordan Capital when we did a merger about a year and a half ago, and Mackey specializes on wealth management or wealth creation.
Payton, thank you so much for chatting with us.
Thanks for having me.
My guest has been Payton Nyquvest, investment advisor at MackeyResearch.com. And that wraps up our show for this week. We'd like to thank our guests Ross Clark, Ross Kay, Mike Swanson, and Payton Nyquvest, and thank you for listening. This show can be heard online on TalkDigitalNetwork.com. Questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.